Blake Richardson from BlockTower Capital, a multi-strategy hedge fund. It's great to have you here to talk about DeFi. Welcome to Real Vision, Blake.
Thank you, Ash. Great to be here.
Well, it's really a pleasure. Blake, before we get started, let's talk a little bit about what DeFi is. It's a term that gets thrown around a lot. Many people probably don't know the exact textbook definition. What's your definition of DeFi?
Sure. So decentralized finance is any application built on blockchains that have some sort of functionality that mimics existing financial services. So we would categorize that as decentralized exchange or trading, lending, assets such as synthetics or even dollar assets, and then insurance contracts as well. So pretty much anything that's in the traditional financial world that you can do there that's replicated on blockchains, that would be the category that would be decentralized finance to us.
Blake, let's break down that taxonomy. What's the one sentence definition of each one of those items?
Sure. So DEXs, for example, decentralized exchanges, the first one, they are basically contracts built on either the Ethereum blockchain or any number of layer one blockchains where users can trade and exchange assets in a peer-to-peer manner without a centralized intermediary. So, for example, in a traditional model, you might have to go through, prime brokers or a bank or other mechanisms to trade, say, stocks, whatever you would trade in the traditional world. In crypto, decentralized exchange would allow you to trade crypto assets, so anything built on that blockchain, or any number of other contracts that are created. Lending would be, exactly what you would expect. It's basically pools of capital that are available to be borrowed out. People, investors, users supply this capital into smart contracts. Those smart contracts then have mechanisms in place that allow them to, basically stay solvent while people borrow from them. They're often over collateralized. And then users, from anywhere in the world, 24/7, near instantly can go in and access that liquidity as long as they match the parameters within that within those individual protocols. Stablecoins are just dollar coins built on smart contracts. So the most famous of which are Tether and USDC. So they're just there's two different kind of primary mechanisms of a stablecoin. One is where there's a dollar one for one sitting in a bank account somewhere. So that's kind of a hybrid of traditional finance and decentralized finance, where then there's an asset that represents that. The other would be algorithmic stablecoins, where it's actually not backed by dollars. We can go into that a little bit deeper later. And then derivatives and synthetics are kind of a combo, but it's any sort of options contracts or synthetic assets, such as synthetic stocks built on a blockchain. And insurance is kind of a similar category where you're insuring against smart contract hacks or custody failures, but using smart contracts on that native blockchain, the most famous of which would be Nexus Mutual, and that provide insurance against other activities within DeFi.
So let's start with DEXs, because they're probably the most widely known at this point. SushiSwap, PancakeSwap, Uniswap, all names that are reported on quite frequently. Give us a little bit of a sense for people who may be relatively new to the space, what the significance of those exchanges are, what they're used for, who's using them, and what the use case is.
Sure. So it's really the first time ever that you could trade an asset with a counterparty that you don't know and don't have any prior relationship with. There's kind of, for better or worse, there's not KYC for some of these exchanges, which means that over time we'll see that kind of probably emerge into the industry. But at least for now, anyone from anywhere in the world can be your counterparty by swapping with these contracts in a manner that allows you to trust the other individual. So when that's the significance. The users are all sorts of users. It's hedge funds such as ourselves. It's individual retail investors. VC investors. It's anybody that wants access to liquidity on crypto assets where people have provided into any of these different exchange mechanisms. Typically, they work by providing liquidity in what's called an automated market maker. Those AMMs have different functionality, but typically they're two-sided 50-50 markets where people supply capital and then people can trade against that capital. So effectively, those assets are sitting in the protocol, and that's what allows anybody to go in and access that. So you trade into one and get out the other. There's a curve that determines the price change as a function of liquidity, and then you're done. There's not really any extra steps beyond that. Why it became significant was crypto in 2017 and earlier was really reliant on centralized exchanges, which kind of is against the ethos of the space originally. It was like we have these decentralized assets, but we really can't access them in a way that removes that middleman. So like large companies such as Binance, Coinbase, others are centralized in that sense. And so this provided an alternative that allows those same functionality without having to worry about like an exchange failure or solvency issues of like a specific business's operations. Another kind of key piece that a lot of people have talked about that was a bigger issue in the past was like insurance, like FDIC insurance against deposits. There's a lot of risks in DeFi, but the one thing you can be sure of is that if you have an asset in that contract and you have the private keys to that, it is your asset. And if that protocol has assets in it, then you know that protocol is solvent. Now, there's a lot of risks that I'm kind of oversimplifying there, but that is very significant. Is like you can see the real-time status of that exchange and know what assets are in it and if it's functioning without any sort of excess or additional layers of audits or other kind of financial reporting, because it's all available on the blockchain.
Yeah, talk a little bit about those risks that you've mentioned. Obviously, these are incredibly new frameworks for thinking about trading assets. What are the risks and how do you categorize them?
Sure. The biggest risk is smart contract risk. There's lots of different ones, but it really boils down to are the contracts designed correctly? And there's a lot of things that come out of that. So one would be like economic incentive risk, where there's say like a token that represents your share in that underlying collateral. That underlying collateral, that token has a price. Occasionally, there's risk of, say, that price deviating based on the oracle that reports that price, going away from the correct value. So that would be oracle risk, but it's kind of a subset of smart contract risk. Realistically, these contracts are new, even though we've tested them for many years now in the space. They're still they're very complex, and there's often just quirks or bugs in the contracts that will result in never all the funds, or at least not to date, but some subset of the funds potentially being at risk or exposed to somebody coming in, exploiting that vulnerability and taking those funds. We actually recently did an analysis alongside the insurance, kind of the insurance theme that we were discussing, of total hacks as a percentage of value locked and exchanged in DeFi. And it's actually a very, very small fraction. So I don't want to overstate the risk. I actually think I have the number here. It's something like a 0.5%, or let's see, something like 0.5% of all assets that have ever been locked in DeFi have been stolen, which is high in a certain sense, but it's also, compared to how new the industry is, it's pretty impressive. And so it isn't like an existential risk, but there is that kind of like, we have to review every new contract we look at. Things like Uniswap, SushiSwap, PancakeSwap that you mentioned have a lot more value locked in them, and they're tested, kind of more frequently. The Lindy effect of them being around longer also makes it less likely that a hack is discovered kind of each day thereafter. But there is still risk to those contracts as well.
Hey, if you like this clip, be sure to check out the full interview and more only on realvision.com/crypto. It's 100% free. Sign up now.